For years, the conversation around Tesla's full self-driving has always been about the technology. But that narrative is shifting. The core challenge for FSD may not be about the code anymore. It might be about something that hits much closer to the company's stock price.
So let's walk through this. We'll start with the fundamental change in the problem itself. Then we'll look at the specific regulatory action driving it, how that undermines a key market belief, and what the real risk is here. Because it all comes down to one thing: Tesla's valuation.
All right, let's jump right into the main idea. Okay, so the core argument is this. Tesla's self-driving issue is no longer just a technology problem. Hold on, what else could it be? It's always been about the technology.
It's becoming a valuation problem, and that's a completely different ballgame with much, much higher stakes.
A valuation problem. So what's the catalyst for that? It can't just be an opinion. You're right, it's not. The trigger is external. It's coming from U.S. regulators.
U.S. regulators have officially escalated their investigation into FSD. Escalated, that's a very precise word. You're not saying they've just continued or expanded it.
Exactly. An expansion is just about gathering more data, and escalation implies they believe they have enough data and they're moving toward a decision on whether to act. That's a huge shift in the status of the investigation.
And look at what they're focusing on: very specific, difficult conditions. Things like driving into bright sunlight, or dealing with heavy fog, or even dust. This isn't some broad overview. It's a targeted probe into known points of failure.
So how does this regulatory action really connect to the stock price? That's the key question. So far, it seems like the market is operating under an old assumption.
For a long time, the market has priced Tesla with one core belief baked in: that self-driving can scale safely and expand to more users at the same time. This regulatory escalation is a direct threat to that very assumption.
Which leads to the obvious question: who's actually in control of that expansion now?
It's not Tesla anymore. It is now the regulator's call. That's a massive transfer of power. If an agency has the authority to approve something, it also has the authority to deny it, or even revoke it.
Okay, so if the regulators are in the driver's seat, we have to talk about the real consequences here. And they could be a lot more serious than most people think.
Let's play that out. What's the realistic worst-case scenario? A hefty fine? A forced software update?
No, that's not the worst case. The real risk is a sequence of events. The regulator makes its call, decides the system isn't safe enough to expand, and then FSD gets taken offline entirely pending a complete recertification.
And that kind of scenario, well, it's not just a fine, it's what's known as a valuation reset. It's a fundamental reevaluation of what the company is worth, because a core pillar of its future value has just been impaired.
Which brings us to the final and really the most important question, the one every investor has to be asking themselves right now.
You have to ask, what is the market actually pricing in today? Is it option A, today's version of FSD, with all its current limitations and now this very clear regulatory risk? Or is it pricing in option B, a theoretical future where FSD works perfectly and scales safely everywhere?
For a long time, the market has treated those two things as if they were basically one and the same. But the question the regulators are forcing us to ask is simple: are those two things still the same?
And just a quick note, the analysis we've shared here is a deep dive into business logic and does not constitute any form of investment advice. Markets are risky, so please be sure to conduct your own independent research before making any decisions.